We're still focusing on the returns of 2011, what that meant for markets. Still with me, Roland Rousseau and Kobie Lekranji. And as I mentioned earlier, only 7 out of the last 50 years we saw negative earnings, and that is obviously very positive. And as I mentioned, during the tough times, it's easy to get slumped in the whole pessimistic view, but overall markets have been performing well, especially in 2011.
Yeah, the interesting thing is and we'll talk a little bit more about behavior maybe a little bit later in the show, but if you just look from a returns perspective, returns are far flatter than what actual earnings are. Earnings from a distribution perspective are far more kind of staggered kind of on the average to kind of the high side. If you just look at your screen again, have a look at the earnings picture that we ended off the show just before the break, and there you can see the earnings for both kind of the 2008, 9, 10 and 11 period, and we're juxtaposing those relative to the 1970 period because the 1970 returns were also quite negative. And you can see the distribution curve that I'm kind of fitting towards earnings in the South African market. Interesting to see that earnings almost is never over the last half a century up between 60 and 100%. But on the odd occasion, we've actually had markets that have increased between 60 and 80%. You've got to be in markets to get these kind of returns.
That's the multiple effect. That's the PE multiple that's driving the earnings.
And that was in 1972, 1999 and 1979 that we saw earnings returns up between 60 and 100% on the JSE.
No, absolutely. And you've got to be in the market for those kind of returns. You're either in or you're not in.
Okay, so let's touch on how earnings actually affect returns. In 2010, we had a good performance by the JSE All-Share, but we know that markets are forward-looking. So in other words, 2011, we expected positive earnings. The performance of 2011, do you think that sort of puts in a nutshell in terms of what we can expect from an earnings perspective in 2012?
Well, the main driver of earnings in the economy and in the market is typically nominal GDP growth. So whatever the economy produces has to have some relationship with what the economy produces in terms of earnings. So the output of the economy and the earnings have to have a relationship. So nominal GDP growth is basically real GDP growth plus inflation. And we're starting to see inflation ticking up. So that is going to contribute to higher earnings. In fact, we might be in
a stagflationary environment right now.
Well, I think the general view is that most people are worried that inflation is going to surprise on the upside with food inflation and the oil price and all of these things where they are now. So that adds to the earnings of the market. Companies pass on those higher costs to consumers. So we will see an inflationary impact in earnings coming through. So nominal GDP growth is expected in South Africa to probably be around 10%, given where inflation is. GDP growth at 3% plus 6% inflation, you're looking at 9–10% for nominal GDP growth. So earnings will cycle around that. So on average, through time, earnings should equal the nominal GDP growth, but at times they're much higher or much lower, as Kobie has alluded with these graphs. So what we're potentially going to see this year is how much higher is earnings growth going to be relative to nominal GDP growth, and that depends again on...
So we have to reach that sort of 10% level, essentially, on the earnings front.
And the key driver there again is the rand, because if the rand is very strong, and I think most people are thinking that the rand is quite weak now and should strengthen a bit, but if the rand goes below 8 again, what tends to happen is that mining companies' earnings, which is a big contributor to the economy, suffer, and earnings growth can be sort of pared back because of the strong rand.
So you're in favour of a slightly weaker rand into 2012?
Slightly stronger rand,
Slightly stronger rand, so below 8 rand to the US.
And that will impact negatively on mining earnings, which will negatively bring down or pull down the...
So you're not pro a weaker, a stronger local currency?
No.
Okay. Just to
because I can't influence the currency, I'm not going to say anything about the currency.
Okay, but it's interesting to take all these factors into consideration that are going to affect returns and earnings.
But you see, our market there are two sides to our market. There's the resource market and then the domestic market. And the rand obviously will impact that. And your earnings forecast for the year is very dependent on what the currency expectations are.
Let me just give you those earnings forecasts quickly. I mean, we're sitting at a 13 PE at the moment. If earnings go up by 10% in the following 12 months, okay, which is, I mean, kind of that's on the lower estimate kind of side. It'll drop the PE down to 12 if the market doesn't move at all. If earnings are up by 30%, it'll drop the PE to 10. And that makes the market kind of more on the cheaper side. Is it screaming buy? No, it's on the cheaper side. That still makes me look at international equities and saying there's a whole bunch of internationals, especially multinationals, that you can buy or fairly decent valuations relative to what you can get in South Africa on an emerging market basis. Now, earnings might surprise on the upside, which is obviously what everybody hopes for. I mean, if earnings surprise on the upside, you're going to have a very decent market during 2012. But other than that, if you just kind of got a flat kind of market, or you've got earnings that are just anemically up, maybe you've got another flat market this year and maybe slightly positive,
And isn't this where you actually start looking, you don't buy into the overall market, so you don't buy into an indice, but you rather stock pick and you look for the companies that are offering value that do have potential to increase their earnings down the line?
Yeah, and you've got to be in the market. That's the other thing. So you don't know when this thing's going to turn.
Would you be buying into the market? Would you be allocating new money into the market right now?
Well, I mean, I think that in the beginning of, if you go back to the beginning of 2011, when the market was sitting at 17, 18 PE, we were certainly, subtracting money out of the equity market here in South Africa. We were aggressively buying international equities, and we slowly started looking again at South African equities towards the end of last year. Let's look what happens to valuations during the course of this year, and you could, you kind of tailor make it as you continue to go.
And for you, Roland?
I do think this year looks a lot better than last year from a fundamental perspective. There are two components to the expected return in the market in 2012. The one is fundamentals and the other one is sentiment. And last year we saw that sentiment was very pessimistic. And if you look at sentiment indicators, you're starting to see them actually improving quite a bit. So I think there is a lot more optimism. And we're seeing also positive economic data.
Absolutely.
Manufacturing data is improving.
The
US is looking a lot better. So everything's pointing in the direction of a more positive a positive market than last year.
So do not fear if you were in the market and only saw 2.6% return, hopefully dividends paid. So let's get into the dividends scenario.
Let's have a look at dividends. I mean, we've looked at returns in the market, we've looked at earnings in the market over the last half a century. Let's maybe have a look at dividends. If you look at your screen, exactly the same way as what we've looked previously at the markets, there you can see dividends. And unfortunately, it's quite small on your screen because most of the dividends that actually get paid, and you can see them there on the screen, is usually up between 0 and 10%. In certain cases, they're up by 10 to 20%. There are quite a few that are up 30 to 40%, but almost never are dividends negative. Let me highlight again the 2008 period. That's now the last kind of subprime crisis that we saw. And just have a look at those numbers on your screen. Have a look at 2009. In 2009, actual dividend income or dividends were down by more than 30%. So that is the total amount that was paid, and the actual how much it actually decreased.
And that's the first time in half a century that it actually happened.
Yeah, and I mean now you can understand why sentiment's so negative, because the first time in half a century, dividend income was it was very, very low relative to where it was before.
It also explains why value investing was really tough last year, because a lot of value investors want a high dividend yield kind of company, and they didn't deliver those dividends in the same degree that they used to.
Yeah, and I mean the interesting thing is, if you're a value-based manager or somebody that looked at valuation, you needed to look at the long-term trend for dividends and started actually fitting numbers rather than actually using actual numbers because of those 2009 numbers, and it's such an anomaly. If you look at 2010, their dividends were up in 10 and 20%, 2011, 30 and 40%. Again, the base effect that Roland spoke about just now. And let me just fit 1970s numbers there. You can see a far different environment than what we saw during the 08 and 09 period. Dividend income never actually decreased in the big fall in the market the last time we saw such a big fall in the market to the degree that it did in the 2008 period. Fitting a distribution curve, that's what it kind of looks like. You can see it running through the graph now. There is a distribution curve. And then never are dividends up between 80 and 100%. People just don't increase dividend income to that degree.
So, I mean, good year for 2011, though, for dividends. Roland, where do you expect it to head into 2012? Do you think they're going to
The dividend yield was high because the market fell was so volatile, and although it was slightly up, by August last year it was very negative, the market. So the dividend yield was skewed last year. But there are two types of value investing. There is where you're going for low PE kind of shares, which are the sort of the hope where you're getting capital gains. And then there's the safer or the more conservative value investing where you're going for yield or income, which is your higher dividend yield strategy. And I think that the higher dividend yield strategy did pay off last year, but the low PE value strategy did not pay off last year.
So then how would you be delving into the markets then this year with regards to dividends?
Okay, well, I mean, firstly, I think that dividend income is starting to, it has reverted back up again. So you've seen that massive fall down in dividends, and you've seen it reverting back up again. I think dividend income...
Back to 2007 levels.
Yeah, I mean, as a matter of fact, if you look at earnings and dividends, and you look at the total payouts that have been made, if you do that over the very long term, you'll see these lines just kind of from an index perspective just continuously increasing. And we're back beyond those previous kind of high points, which kind of means that from a dividend perspective, you probably see more dividend growth this year. To what degree? Well, that depends on how much earnings actually grow. But the important thing, I think, Eleni, for me, is the fact that you've got to be in the market in order to earn some of these returns, because you don't actually know what's going to happen to markets on a year-on-year basis. A lot of people pulled their money out of the market last year, but the market was actually up by 2.6%. And if you just look at your screen quickly, you'll see the distribution curves that we looked at a little bit earlier on. And now what we're doing over here is I'm actually fitting the distribution curves for both share returns, earnings, and dividends all together. And you can look at share returns over there. You can see what the distribution curve looks like. And then relative to share earnings, and that's in green. And then share dividends, which is kind of the one that's kind of on the high end of the screen over there. Now, if you look at share returns, we kind of act far more irrationally about actual share returns, because that's something that we control as a market. But actual earnings and dividends that long-term actually drive returns are far more narrow. So that the market actually provides for you as an investor is far more predictable than how we actually treat share returns. And invariably, that's a positive argument for active fund management, because we are going to overreact.
Just to reiterate, do fund managers look at this kind of information, this data, looking at historical trends? Is it even important in terms of what will be occurring in 2012?
I think fund managers look very much at dividends and earnings, and they try and forecast these things all the time. And
are historical trends important with regards
your
to
forecast
forecasting?
Depends on where it has been, so very much so. It depends on historics. There are two types of fund managers: fundamental fund managers, those that are much more short-term focused, and those that are much more interested in where they are in the business cycle. Those tend to have much slower kind of churn rates in their funds and look at long-term trends. And obviously they could be wrong for long, but in the long run, hopefully they come out just as much as anybody else.
You see, I mean, the big problem, I think, with most investors, and this is not professional investors, although in some cases I see evidence of it, is that we don't use, or investors don't use what's called a valuation-driven emotional cycle. They just use an emotional cycle. So when things look volatile, they pull their money out the market regardless of what the actual end result over a calendar year is going to be. If you use a valuation-driven emotional cycle, you'd be saying, well, what's the valuation in the market, and do I want to participate in a market like that, or don't I want to do that? People don't necessarily do that kind of thing. I mean, total returns for 2011 up 2.6. If you pulled your money out,
okay, what's your money on 2012?
Well, I think that equities will do okay this year. Will you lose 10, money?
Above 10, above nominal GDP?
Well, I think from an asset allocation perspective, the first thing you want to know is it going to lose money or not? Because it's about absolute returns. First, do no harm.
I'm asking for a forecast, Kirby. What's the number?
And you know I don't forecast. You know I don't forecast.
Tell me.
That's why I don't know.
Okay,
how's that?
Well, our analysis shows that we're probably expecting between 19 and 24% returns for 2012.
Fantastic.
Is that returns?
Returns.
Returns. Based on what earnings growth?
But between 10 and 15%.
We shall see.
We shall
at the end of the year.
Could you please put a number on the table so that we can watch this show back
no,
at the
I
end
want
of
to see.
2012?
Look, you know what? I'm the fundamental analyst.
Commit.
He's the quantitative analyst. So I'm going to take his number.
No commitment by Kirby Lekhanji. This shall be remembered. Gentlemen, we have to leave it there. Thank you very much for joining us.